Hello, everyone. This is Keesa Schreane, and thank you for joining. 2020 will be known as the year of the pandemic, global racial unrest, and economic volatility. It may also be remembered as a time when environmental, social, and governance change became mainstream. Just look at the evidence. Media and industry focusing on gender and racial equality, corporations pivoting towards climate initiatives, and organized partnerships to increase work toward meeting the UN Sustainable Development Goals deadlines. We also see evidence of this change in the discussions from the UN's General Assembly on this week, discussions ranging from protecting the Amazon rainforest to recommending partnerships for defeating the pandemic. Today, we're drilling down a bit deeper into the climate change and carbon emission aspects of ESG. Specifically, how can quality and transparency of data support goals around climate and reducing emissions? And interestingly, what do these things mean for automakers focused on hybrid and electric cars? Here to discuss this with us today is Refinitiv's Global Head of ESG, Elena Philipova, Co-Chair and Managing Director of Constellation Research and Technology, David Lubin, and Andrew Howard, Global Head of Sustainable Investment at Schroders. Thank you for joining us, everyone.
Thank you.
Thanks.
So, Elena, this summer we discussed the impact of COVID-19, the pandemic, on the physical risk to supply chains and operations with Nick Villani. Could you give us an outline on how climate change risk affects business operations and the investment portfolio in general?
Thank you, Keesa, and hi, everyone. Indeed, today, while the environmental impact of climate change is well documented, the economics actually are as dramatic. Cumulative damages could reach a staggering of 8 trillion by 2050, according to the IPCC report. So the costs, vast majority of which are actually currently not priced, are significant. Climate action is about ensuring the stability and security of our economy. And our priority today must be to steer the economy away from that financial cliff that we're facing. We're given actually a quite unique opportunity to rethink and rebuild more sustainable and resilient social models, financial markets, and business structures. And in recent years, we've seen many examples of companies redesigning themselves, rebuilding their business models, and truly integrating sustainability inside, not just beside the business. And what's even more important is that those structural changes of bringing purpose alongside profit delivers the financial outperformance as well. Another point I think it's important to acknowledge and mention at the beginning of our conversation today is that COVID will not be an isolated pandemic. Given the increasing pressures on our environment triggered by climate change, by biodiversity loss, experts are warning that we should expect more pandemics. And therefore, building resilience into everything is essential so that we're better prepared for the volatile future. All investments need to consider issues of adaptation, of physical resilience in the face of a rapidly changing climate and increasing climate inputs. The crisis really teaches us that we need to be aware of the implications on other environmental areas, on social, and the connectivity, the intimate connections that this has to the economy and to financial markets. So the resilience needs to be all-encompassing, and we cannot tackle one problem in isolation.
So Elena talks a bit about resilience and how there's a need to build that resilience into everything as we prepare for a volatile future. Andrew, let's talk about this volatile future in terms of the types of assets that we're seeing created off the back of that. What's the investor market outlook from the lens of assets like climate bonds and green bonds and even COVID bonds that are now have hit the market? Can investors really rest assured in this trend being a steady growth in terms of these types of bonds?
You've certainly seen a lot of growth in some of those areas that you've mentioned over the last few years, obviously COVID bonds more recently. But I think it's worthwhile thinking about this in two questions, really. One, on the one hand, as any investor, any asset, any financial market is exposed to the risks and the opportunities created by challenges like climate change. I'll focus on that to keep life simple, but actually what we're talking about is moving into a much more complicated, much more fast-moving world in which assets will be increasingly impacted by the effects of social and environmental change. And the first question, therefore, is for any investor, this isn't a choice. It's not a choice about whether or not I want exposure to that particular risk or that particular trend. You will be exposed to it. And the first question is, to what degree is that risk being managed? Is that being reflected in the way that portfolios are being managed, whether or not they're called climate bonds, whether or not they've got sustainable in the title? It's a challenge that we all have to grapple with as investors. And let's not pretend that's a simple exercise. But that certainly has to be the baseload, I think, and the starting point wherever you look. Beyond that, as you say, clearly there are also a number of more discrete and focused asset classes that are emerging, whether that's in the fixed income world in terms of green bonds, as an example, social bonds, climate bonds, SDG bonds, all of which are tackling specific problems and helping to reallocate capital, whether that's through things like microfinance, similarly, which has continued to grow very heavily over the last few years, whether that's through things like climate funds, and again, which have grown very rapidly over the last few years on the equity side. So you are seeing that rapid growth in specific areas. And I think that will probably continue, and certainly our sense is that investment in those areas is only going to increase in terms of the real world investment demand. And it's therefore going to be imperative that as investment managers, as asset owners, that we're able to reallocate capital towards those solutions and that we're able to meet that demand going forward. But I do think that sort of really trying to break this up into one, the question of how do we think about those risks across any fund? And secondly, how do I get more focused, if you like, exposure to particular issues through the widening variety of vehicles that are starting to emerge and the widening variety of fund types are really the two sides of the coin that any investor, as they think about the future, as they think about the issues that are important to them, as they think about the trends that they think will unfold, how you've got those two pieces of the puzzle that really need to fit together.
So if we're talking about risks that all investors need to grapple with and really thinking through how to manage those risks, one question is, first of all, how do we measure risk? And David, I would love to get your thoughts on what does the measurement tool or tools look like in the future? What kind of updates do we expect to see with those measurement tools to really bring investors where they need to be in terms of measuring risk?
Yeah, the sort of length and depth of the report we just released on the auto sector is a testament to just how complicated and difficult it is to create an accurate picture of what those transition risks and opportunities look like. I think that the big challenge that we see if we look at these carbon-intensive sectors like the oil and gas sector, the utility sector, the auto sector, is trying to understand what is the kind of cornerstone metric that you need to build on to get a picture of the transition progress and potential and readiness of any given company. In the auto sector, we think that cornerstone metric is grams of CO2 per kilometer of the sold fleet of each of the automakers. We know that our previous analysis of the 250 largest emitting companies on the planet told us that more than half of those companies had their emissions, their dominant emissions from their sold products. And the auto sector, of course, is right up there with more than 80% of its impact from the products it sells. And while there's been a great deal of interest on Scope 3 reporting, the ability of an automaker in good faith to set their own parameters about the average number of miles a car will be driven a year or the length of time the car will remain on the road, in fact, can be the model making variables in any kind of Scope 3 comparison. whereas grams of CO2 of the fleet actually sold by the automaker in any given period is kind of the gold standard. So we built on that data and then built a whole family of analytics around how that grams of CO2 has trended over time, going back several years. And based on a rule-based analysis using the projected model announcements of all the major car makers for high efficiency vehicles, electric vehicles, etc., we were able to project the trend line of that grams of CO2 per kilometer out into the 2025, even to the 2030 period. That gives us a real look at what's happening in the sector. And you'd have to say, overall, the picture is we're a good long distance from where we need to be. You know, a big transition we talked about in the report in the last decade is the transition from relatively efficient passenger vehicles to relatively inefficient SUVs. In this year, roughly 25 million new mid to large SUVs will be put on the road, almost all of which are gasoline powered or diesel powered vehicles. They will be on the road for a good long time. And next year, a similar number is likely to be produced. We're still trending in the wrong direction on overall grams of CO2 per kilometer of the sold fleet for a substantial number of the automakers.
So David, let's drill into that a little deeper. I'd really like to get Elena's thoughts on climate risk analytics data. So we're talking about the cornerstone metric David mentioned, being the grams of CO2 and how he's built that out. But Elena, if we look broadly, how does analytics data play a part in all this?
So I think that I hope you can hear me. There seems to be a bit of a technical issue, but hopefully that's working fine now. According to the IMF report, which was released earlier this year on global financial stability, the development of mandatory disclosure is necessary to sustain financial stability. And I think this is a key message. Analytics are built on reliable underlying data that the underlying entities' assets have released or acquired through different sources. So transparency and mandatory disclosure is definitely quite critical. Given the climate data and trends, financial stability authorities have become actually quite concerned that the financial system may not be well prepared to cope with the large increase in physical risks as well as with the so-called transition risk, which results in from change in policy, change in technology, legal frameworks, and just structural market changes, which are occurring during our transition to low carbon economy. I guess the good news is that there are a lot of emerging initiatives led by both the private sector and the public sector to solve for that problem, to solve for the challenge that exists in the market around transparency and standardization, to facilitate better analytics at scale. Just maybe to give an example, recently the 5 major corporate reporting bodies got together and published a commitment to unify the criteria for ESG or corporate sustainability reporting, which is a huge step forward. But I think it's very important to be clear on where we expect to see those alignments, this harmonization happening. And I would argue that we do need those commonalities. We need harmonization at the level of definitions, at standards and data disclosure. But we don't need harmonization. We don't need commonalities on analytics. Analytics is what brings breadth and depth to financial markets. Just like we don't expect commonalities and convergence of sell-side analyst recommendations. So the bottom line is that the shift to of capital markets, of financial markets towards the 2030 agenda on sustainable development and a resilient low-carbon economy model simply cannot happen without better definitions, better standards, and better disclosure.
So as we're talking about,
if I could just, I fully support what Elena said. And, you know, I mentioned that cornerstone metric in the auto sector, but I didn't mention that it's not widely reported by the automakers. You have to go through many cartwheels to figure out what that number is, just like you would, you know, the tons of CO2 or GHG per megawatt in the utility sector, or the CO2e, you know, per barrel.
But what can change that, David? If it's not something that's not
good work of people
what
like Elena, what the good work of people like Elena and Andy on these various panels and expert advisory groups can change that, and you know, and experience trying to make sense of the data that points out, well, where are the holes? You know, can change that. The report we just released with Refinitiv, I think, brings brings a dozen new metrics to the auto sector. But one in particular is what we call the sustainable value ratio, which is our assessment of transition opportunity in comparison to transition risk for each of the automakers, projected, you know, both a present view and a projected future view. But that depends upon some of these cornerstone metrics being created. And it would be nice, just as Elena said, it would be nice if we had a more representative, fact-based cornerstone metric set for each of these carbon-intensive industries that clever guys like the people who work with me could turn into really powerful metrics to not only describe the present state, but predict the future.
So let's shift gears there for 1 second from the cornerstone metric, which is a great point, to talking about some dollar figures here. And you talked about the report that you did with Refinitiv earlier this year. Elena, I know in January, Refinitiv CEO David Craig spoke about a potential $4 trillion carbon correction to the markets. And I'd love for you to just speak to the investment exposure due to climate change in context of that.
That's right. And earlier this month, actually, I think something else quite interesting happened in the industry, which is important to link and connect to this prediction that our CEO made earlier this year, which is that for the first time, an expert subcommittee of the Federal Financial Regulatory Agency in the US issued a quite significant report on climate risk, which is also accommodated with recommendations, with real recommendations that the Fed, the SEC, and other US financial regulators should act very swiftly to address climate crisis as a systematic financial risk. So I think that it is the stars are signaling it wherever you look. I mean, this mispricing of climate in capital markets is sooner or later going to happen. And as mentioned, there are two types of climate risks. Transition risks, which many would argue are already well priced into assets. But then you also have physical risks. And the physical risk is where there is a huge gap between understanding, between measuring, and being able to then manage and properly price. So we're making great progress in some areas, but certainly there are huge challenges remaining in front of us to solve for before we can have a true view of the costs related to our portfolios, to the businesses, and to the economy.
And we talk a lot about the risks here, but if we look at the flip side of that, there are opportunities. Andrew, the decarbonizing economy will provide those risks as well as some opportunities for many industries. And could you let us know some of the key areas that automakers, for automakers that investors may be interested in terms of not just the risks, but the opportunities as well?
I mean, you're absolutely right. What we're talking about is a disruption, and a disruption has both risks and opportunities that fall out of it. And what we're talking about with climate change in particular is a massive disruption. You're talking about effectively reversing the process of industrialization that played out over centuries and doing that in 20 years. And the idea that that's not going to create huge casualties in some places, but also huge winners in other places, it makes no sense. So I think certainly the way that we look at this is you've got two sides to the coin. You've got to think about this first and foremost in terms of how is that transition going to play out, as in what will cause us to get from where we are today to a low carbon world. And I'll just focus on the transition piece for now. And the two big areas that we find become the most important areas are, on the one hand, the incremental cost associated with penalizing carbon, effectively regulation in the form of carbon pricing. And on our numbers, and I can't work this out in my head quickly enough, but it sounds like a similar order of magnitude to those that you mentioned earlier. On our numbers, something around about 15% of the value of equity markets globally would be at risk as a result of that increase in carbon pricing. On the other hand, the other big area is the reallocation of capital from traditionally dirty industries to greener, more lower carbon industries. Those industries, those product areas that are able to help support the transition to a low carbon economy within the context of autos. The obvious thing that we're talking about here is a transition from ICE, internal combustion engine cars, to electric vehicles, and all of the infrastructure and value chain shifts that come alongside that, both in terms of the charging stations, the energy grid that feed into that, and on the other hand, on the loser side, clearly the entire network of refining, petroleum stations, and so on. And I think the way we look at that, at least, is to start with, where does the world need to get to? So if we're looking at this through a scenario lens, what does 2 degrees look like? How many electric cars would need to be on the road in a 2-degree world for the maths to make sense, for emissions to have fallen far enough? What rate of growth does that imply? And I'll tell you now that we may think that electric cars are growing quickly, and they have been last 6 months aside. But actually, that rate of growth needs to be sustained for quite a long time if we're going to get to putting enough electric cars on the road to reach net zero carbon emissions sometime in the next 30 to 50 years. So it has looked quite dramatic in terms of the shift, but imagine that level of growth being sustained for decades. Mm-hmm. Or for a very long period of time. That's not quite as straightforward as therefore anyone that makes electric cars is therefore going to suddenly be worth a fortune. The relationship, as we've all seen, whether it's through alternative energy technologies over the last decade, the relationship between an industry growing and shareholders benefiting isn't as linear as people would assume. Mm-hmm. And actually, it's equally important to understand to what degree are companies that are operating in markets that will grow quickly able to capture that growth in the form of profits and in the form of value creation. And that's where the relationship between how climate change will impact industries and growth rates and technology areas and investors, and where investment risk and opportunity comes from is the real challenge. And I think that's very much from our point of view where we see our value add and our focus is on how do we understand this, or how do we translate this understanding of how the world needs to change into an understanding of what that means for investment portfolios.
And so, David, bringing us back to the issue of automakers, how are automakers preparing for climate change in this advanced state? And are there any surprises that you found in your research and in your analysis for this preparation?
Well, I think one thing I guess I would say is, based on at least the analysis that we've done, I'm not sure the market has a clear picture of what those transition risks and opportunities look like. I think there's a great deal of cloudiness, and I can see that because when we look, although we see a linear relationship between our sustainable value leaders, contenders, defenders, and laggards, and total shareholder return over a 5-year period, or the previous 5-year period, there are several companies that stand out to us for their combination of very strong shareholder returns and very low sustainable value ratio. In other words, meaningful, well above the industry average transition risk. And likewise, there are several companies that we report on who have underperformed financially, but we think are relatively to the sector, well positioned for the transition that they'll need to make over the next 5 to 10 years. So we think that there's still a lot to learn about how to price that transition risk and opportunity, at least as we see it from the report that we just released. The surprises, I guess, if coming down to a couple of specific cases, what is in some ways surprising to us is that two of our among what we call incumbents, the current internal combustion engine powered automakers, both VW and Daimler, both fresh from each of their Dieselgate experiences, who have relatively low experience both building and selling hybrid and alternative powered vehicles, have set forth the most aggressive and ambitious transition plans, new model introductions as we've quantified them, and have laid their claim to leadership in the emerging electrified vehicle market. Whereas somewhat surprising to us, and it may be culturally and stylistic, Toyota, who has been for decades the efficiency leader, and who has built a reputation around their green credentials, has a relatively unclear to us, at least as through our analytics, a much less clear picture of how they plan to dominate the electric vehicle market as they did the hybrid market when it first emerged. And so it is a surprise to us that the company who one might have thought was most well positioned to lay out their expansion plan and dominate the next decade is being eclipsed by others, in particular VW and Daimler, who are fresh from their own experience with their diesel production.
Wow. And so if we were to bring all this together, and that's a great point, Elena, we'd love to get your thoughts on bringing the points from David together and really think about what should investors look for to create their own climate risk analytics. What is your thought on that?
I guess few advices. The first is acknowledging that this is a transition. There are lots of moving pieces and not perfect answers for everything, including not perfect data for everything. But there are lots of great examples of how to overcome the challenges. So the first, I think, most important recommendation for investors here is to seek diversity of sources. Diversity of sources is really important because that enables you to close some of the data gaps that exist, complement and have a more comprehensive and accurate view on the climate performance that will then enable you to calculate and have more accurate climate analytics. We at Refinitiv, for example, use also quite a lot of different sources to try to stitch them together and provide that complete view to our users, to investors, whether that's from companies' self-disclosure, which we need to acknowledge for most part today still remains voluntary, and that comes with benefits as well as some downsides. But then we also source information from third-party sources like NGOs, governmental data sources, and of course, reliable media and news to have that outside-in view and be able to validate which companies are walking the talk. So diversity of sources is important. just the second piece, which I would emphasize, is own your own due diligence, own your own final decisions, and ultimate understanding of what the analytics say and what the data says, because there is a whole palette of data solutions available in the market designed to solve for different use cases. And there is sometimes a mis-expectation and misunderstanding of what a data source or a specific analytic is designed to solve for, and may lead to misalignment. What I mean is there are data sources designed to assess, for example, what impact businesses have on environmental and social challenges. And that's not necessarily signaling and indicating the material financial impacts of those externalities, those systematic risks and challenges on companies or businesses' financial performance, and vice versa. So depending on the use case, it's very important to ask the questions, make sure that the information, the analytics, is indeed aligned with the investor strategy, with the investor objective, and ultimately owning the end decision.
Great. You know what? We're really keen to get to the questions. Thank you for that great answer. We have some questions for the audience, from the audience. And the first question is, once the COVID-19 pandemic has come to a head, will this, in quotes, goodwill to change the world continue, or will companies fall back to their old ways? Who wants to take that? Great question, audience. Thank you.
Well, if I was to believe the data that we just presented, I would say that 2020 will look an awful lot like 2019 in the auto sector, meaning we'll put a tremendous number of mid to large SUVs on the road, just like we did last year and the year before. And we'll defer to another day the big advances we need in electrification and decarbonization of vehicles. We'll face that challenge. I think, as Andy and Elena have both said, these are just like the pandemic. The costs and problems that we'll face are not up to us to decide to address or not address. They are coming our way. And the time it takes to make the changes we need to make, we know, is long. The lead times are long. But I don't have a great sense of optimism that suddenly the pandemic is going to have woken us up to existential risk, like the risk we face from climate change. I do think that the increasing success in the marketplace of those companies that are meeting that sustainable value question may be, along with better products that are cheaper, just like the LED light bulb. Nobody wanted it until it was clearly cheaper and better, and then everybody wanted it. And I think we're going to reach that same situation in many of these carbon-heavy sectors, in particular autos. There will come a point, and it won't be too far in the future, when the obvious advantages and costs will be on to the great benefit of alternative vehicles.
Wow, great. Thanks for that, David. I'd love to get Andy in here too to get his thoughts. Andy, what do you say?
I was just going to add briefly, to David's point, and I think just in the question as well, if you look at companies and industries and corporate leaders over the last 15 years, there has been a change. And that's not always been a willing one. It's not always been a far-sighted one, but either by hook or by crook, a large part of the corporate world has had to change. If you, again, just to put an evidence point to it, if you look at the World Economic Forum run an annual risk report, and back in 2007, 2008, and you asked executives of global companies what they thought the top risks were, none of them were environmental and social. No. Today, they're all either environmental or social. And you have seen a sea change in how companies perceive what they need to do in order to compete. COVID, I think, could prove, or it could go either way. Time will tell. But 2020s were the decade in which we needed to see big change. This is the decade in which we need to see decarbonisation really, on a persistent basis, start to happen globally. It hasn't happened for the last 30, 40, 50 years. We've had short periods, but nothing persistent. Is this the start, at the very start of this decade, is this the kick that starts to turn the corner? We will see, time will tell. But I actually think that if you look at some of the announcements that are coming out, if you look at what the EU has done around the Green Deal and where it's redeploying capital and using the stimulus from COVID to really focus on green solutions. If you look at the announcement that came out of China in the last day or two around meeting net zero emissions targets by 2060, which, yes, it's a little bit further away, but if you look at the rate of growth in China, that's a very ambitious target. If you look at the commitments that are being made in the EU, all of this has happened during a COVID period. I actually think there's a lot of reasons to think this may be the catalyst that transitions climate change from being the thing that will be an issue in the future to the thing that is an issue right now. And that will happen very, very quickly. And companies that haven't prepared for that are going to find it very difficult to catch up, particularly in an industry like autos.
Absolutely.
Elena, do you have a final point after that point of optimism there that this is the time? What would you like to add to that? I saw you shaking your head in agreement.
Yeah, I fully echo the same sentiment. I think that there is a lot of industry momentum and a lot of quite important changes and shift happening that should give us a sense of optimism that change is happening now, and it's going back to the old way, simply not an option.
Great conversation today. First of all, we talked about building resilience into everything to better prepare for a volatile future, a future where we're expecting, unfortunately, more pandemics. Investors will be exposed to risks. It's really important to understand how those risks should be managed. Transparency and mandatory disclosure, critical. I think that's something we've heard a lot about over the last several months. And we need harmonization around the level and definitions as it relates to disclosures and defining things. We don't need commonalities on analytics, and we should look at analytics from the perspective of bringing depth and breadth to financial markets. Understanding what the cornerstone metric is to build upon it. David mentioned with the auto sector, that was the grams of CO2 and how that's trended over time. And also looking at two types of climate risk, very important to see that perspective, transition as well as physical risk. And physical risk is where we have that gap between understanding and really understanding how to properly price it. Climate change is disruption, that coming from Andy. There are risks and opportunities, and we really need to get a clear understanding of what opportunities look like. So amazing conversation. I think that this will definitely continue in the future. Andy, David, Elena, thank you so much for joining us.
Thanks a lot. It was a great pleasure.
Great. For more about climate risk analytics, you can feel free to download a new report that we have. Just scan the QR code here or check the link in the chat. As we discuss 2020 in context of it being a year of turmoil and change, as we've just done, we cannot overlook what's happening in our communities. In the Black community in the US, in my community. On a personal note, I wish to give Breonna Taylor's family and the community my wishes and prayers and hope for healing. As always, thank you so much for joining us. Thank you for joining Refinitiv Perspectives Live. Feel free to follow our social media channels and subscribe to the Perspectives blog newsletter to get notified about the next live stream. See you again online soon, and be well.